Hello, Gapper Scott here in this Gap Wrap for Friday, March 5th. Before I get started, don't forget about the upcoming webinar, what we call a Tuesday treat with Metastock. Is going to be demonstrating one of their system-based strategies. It's pretty interesting, and hopefully you can make it. That's at noon on Tuesday. It's free. Just be sure to register right there. This is part of our monthly plan to invite guests in to demonstrate different tools, techniques, systems, anything they want to share. So check it out. It is free. So on Friday, after the Employment Situation Report, commonly known as the Monthly Jobs Report, came out, markets were pretty bullish, but not overly so. I'd call them mid-sized gaps. Let's see. I'll show you the futures guides. And I'll take a quick look at the ETFs, at least the spider, so you can see for comparative purposes. So we were opening above Friday's highs, but check out the market condition data. Really good data. 73% win rate, profit factor well over 2 based upon patterns. Very good number as well. Seasonality, win rate a little bit weaker, but profit factor also very good because generally you have larger gaps in the zone. Again, all these numbers are based upon standard stop of 30% of the 5-day average true range. Or if ATR is really reduced like it has been, then it uses a minimum of 5 points. All the data is generated using that assumption. Okay, so on the surface, the ES looked pretty good. YM not quite as good. Good for market conditions, weak on patterns. There was some pattern risk in the YM. I'm not even sure what it was, but there was. And similar scenario on seasonality. Neutral win rate, but good profit factor. So not quite as attractive. Based on the NASDAQ, market conditions very good, but patterns terrible and seasonality terrible. Based upon historical results in that index. And then the Russell was sort of just a neutral kind of setup, except for seasonality was good. So sort of odd data. Not terrible, but well, NASDAQ was pretty weak. Russell was so-so. YM was marginally good, and then the S&P was very good. Take a quick look at the ETFs. I always look at the ETFs and the futures because I'm looking for consistency. Check out the spider based on market conditions, very good. Patterns not quite as good, but not bad either. And then seasonality is sort of the same scenario, so still not terrible. In fact, somewhat attractive. Looking at the diamonds, same scenario. 2 out of 3 good, patterns not as good. Qs, actually 2 out of 3 were good in the Qs as opposed to 1 in the NASDAQ futures. Only patterns were weak. And then for the filters among the Russell, seasonality was actually good. So there was some discrepancies, as you can see, between the ETFs and the futures, but on balance I thought it was attractive enough for at least a partial size trade. But it was the day of the monthly jobs report, and as I mentioned, I failed to mention in yesterday's video, or Thursday's video I should say, I did mention in my in the daily Gap Wrap, the email that we send out. In the tip, don't forget that it was the gaps up on the day of the monthly jobs report historically riskier. In fact, that's the note I make right here in my pre-market comments. And let's see, and we were opening above, I'll come back to that. We were opening above R1, which is, as I mentioned, the New York Traders Expo, and I've often talked about. It's one of those key patterns you need to pay attention to. It is definitely a risk factor, opening above R1. So here's the deal. We had a major risk of opening above R1, and it was the day of the monthly jobs report, which historically has been a riskier setup. However, when I weighed out all the data, for the UH zone, it was an okay setup. It certainly wasn't as good as many setups, but it was tradable. It met my minimum criteria, and I was going to trade it with a greatly reduced position size just because this whole up gap thing on day of the monthly jobs report. I was going to use like a quarter or a third size, which is my standard protocol if I even trade an up gap on this day. But I was going to say I made the mistake. I wouldn't call this a mistake, but in being thorough like I normally am, I dug into the data and updated it on the monthly jobs report. And let me show you what's happened since 2006. You can read it right there. Oh, actually right down here. 10 of the last 11 times, it's really since 2005, have filled in the UH zone on the day of the monthly jobs report. So actually opening in this zone in recent history has actually been a good thing. And let me just show you that that recent history. Last one was September 4th. This was using 10 contracts in the E-mini S&P futures as a baseline for the testing, and winner, 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 winner. Last loser was in May of '06, and then there was a winner before that in '06. And it did look like there was a string of losers in '02, '03, and '04. But I was intrigued by the fact that this string was so big. So that talked me into, quite frankly, using a half-size trade. And that's what I did. I decided to trade it with a half-size trade, which is very aggressive for this day for me, at least based upon how I've historically traded it. My plan was to use a 7-point stop if needed to get above R3. Luckily, it was not needed. I only used a 5-point stop because that put it above R3. Let me show you how the trade worked out if you happen to have your head in the ground on Friday. See the white lines where we open in each of the indices. Green line is the prior day's highs. We opened well above the highs in that UH zone and came back a little bit at the open and then busted a move to the upside. Let me expand this on the ES. So couple of candles that were down. We held, there's lots of confluence actually on the confluence guide in this area, held right at the top of it, bounced, ripped higher. My target, I was trying to be conservative, was going just a tick above yesterday's highs, and it missed me. So basically came 3/5 of the way, 3/4 of the way maybe, to my target and then reversed. Did not come within 1 point of the 1-point rule, so when it busted a move, as I like to say, to the upside, it stopped me out. And cost me 5 points on that half-size trade. So not the end of the world. The only thing that I sort of have questioned is the decision to trade a half-size on a Friday on this historically riskier day. But I guess the one thing, the teaching point, or the learning point for me is, not that I didn't already know this, but when you get sample sizes, 10 or 15, even 20, it's just tough to trust, even if the last 10 have all been winners, or 10 of the last 11 have been winners, as is the case in this particular scenario. But tough reminder there. But again, I would trade it, the scenario again. I'm right 2 times on 3. Unfortunately, not much more, but fortunately, not much less either. Let's look at this action on a daily chart. Huge candle up, candle up, candle up, candle up. So we have large gaps up that did not fill, and a gap down on Monday would, assuming it's in the body of the candle, would be above the highs. Let's see if I can expand this for you. Above Thursday's highs. Do you follow this? So that's a really strong, that's 2 big check marks for a gap down, any size gap down that's in the body on Monday. Just based upon those 2 patterns would have 2 big positives. Now I will defer to the gap guys. Mondays tend to be a little bit normal. We're significantly overbought, so there's a chance that I wouldn't trade a down gap on Monday, but this is 2 big positives, and I'll certainly look forward to hopefully getting a good setup in either direction. And that's it. Don't forget to sign up for the Tuesday treat. Otherwise, have a great weekend, and that is the Gap Wrap for Friday, March 5th.